All right, let's talk about Soho House. If you've never heard of it, picture a members-only club. But instead of old men in tweed jackets complaining about the government over a glass of warm sherry, it's filled with people who unironically use the word synergy and whose job title is something vague like creative strategist. It's a global network of exclusive clubs, hotels, and restaurants pitched as a haven for people in the creative industries. Think filmmakers, artists, and people who design logos for tech startups that will inevitably go bankrupt in about 18 months. It's the kind of place where you might see a famous actor sipping a ridiculously expensive cocktail next to someone who claims to be a disruptor in the artisanal kombucha space. It's a whole vibe, as the kids who can't afford the membership would say. Founded in London in 1995, Soho House was designed to be the antithesis of the stuffy, traditional gentlemen's clubs. No suits were allowed, which was actually pretty revolutionary at the time. Instead, the dress code is basically look like you just stepped out of a high-end catalog for people who own a single, very expensive plant. So what in the world does it mean for a company to be taken private? It sounds very dramatic, like a celebrity retreating from the public eye to focus on their family, which usually means they've done something embarrassing. And honestly, that's not a terrible analogy. When a company is public, it means its shares are traded on a stock exchange, like the New York Stock Exchange. Anyone with a brokerage account and a dream can buy a tiny piece of that company. This means the company is subject to intense public scrutiny. It has to report its earnings every 3 months, and if those numbers aren't what Wall Street analysts hoped for, the stock price can plummet faster than my optimism for the future of democracy. Taking a company private is the exact opposite. A group of investors, usually a private equity firm or the company's own management, buys up all of the publicly traded shares. Once they own all the stock, they delist the company from the stock exchange. Suddenly, it's no longer beholden to the whims of the public market. Now for the main event, the $2.7 billion deal to take Soho House private. Yes, that's billion with a B. For that kind of money, you could buy a small island or, approximately 4 avocado toasts at one of their rooftop bars. The buyers in this scenario are not some mysterious corporate raiders. In fact, it's the company's own chairman, Ron Burkle, and his investment firm, UKPA, who are leading the charge. They already own a significant chunk of the company, but now they want the whole thing. It's like being a guest in a beautiful house, liking it so much you buy out the landlord, and then telling all the other tenants they have a new boss, and it's you. The reason for this grand gesture is quite simple. Soho House, despite its reputation for being impossibly cool, has been struggling as a public entity. So, if you're one of the lucky few who has a coveted Soho House membership card, what does all this corporate maneuvering mean for you? Will you suddenly need to remortgage your house to afford your membership? Will the picante de la casa be replaced with a generic spicy margarita? These are the real questions. The immediate short-term answer is likely not much will change. The new owners are buying the company precisely because they believe in the brand and the experience it offers. Radically altering the formula that attracts members in the first place would be like buying a prize-winning racehorse and immediately trying to teach it to juggle. It's counterproductive. In the long run, however, members might start to see some subtle and perhaps not so subtle shifts. With the pressure to deliver quarterly profits gone, the management might feel empowered to double down on what makes Soho House special, the experience. This could mean more investment in the physical spaces, better amenities, more ambitious designs, and faster renovations. Let's not forget the thousands of employees who are the lifeblood of Soho House. The bartenders, the chefs, the front desk staff, and the housekeeping teams who create that seamless, luxurious experience. For them, a buyout of this magnitude can be a period of great uncertainty. When a company goes private, the new owners often look for synergies and efficiencies, which are polite corporate euphemisms for cutting costs, and that can often mean layoffs. The new management will be combing through the company's finances, looking for ways to make the business leaner and more profitable, and unfortunately, payroll is often one of the first places they look. On the other hand, a move to private ownership could be a positive development for some employees. A company that is no longer obsessed with its quarterly stock performance might be able to invest more in its people. This could mean better training programs, more opportunities for internal advancement, and a renewed focus on creating a positive work culture. So, why would any company voluntarily jump off the public stage and into the arms of private equity? It seems counterintuitive. After all, isn't going public the ultimate goal, the corporate equivalent of winning an Oscar? The truth is, being a public company is not all red carpets and champagne. It comes with a mountain of regulatory requirements, intense scrutiny from analysts and the media, and the relentless soul-crushing pressure to meet short-term earnings expectations every 90 days. This pressure can force a company to make decisions that are good for the next quarter's stock price, but bad for the company's long-term health. Let's use an analogy. Imagine you're a farmer. As a public farmer, you have to bring a perfect, shiny apple to the market every single day. If one day your apple is slightly bruised, everyone panics and says your farm is failing. This forces you to use pesticides and growth hormones to guarantee a perfect apple daily, even if it depletes your soil over time. Going private is like saying, forget the daily apple market. I'm going to focus on cultivating healthy, organic soil. It will take a few years and my output might be inconsistent at first, but eventually I'll have the best, most sustainable orchard in the valley. What does the future hold for Soho House now that it's retreating behind the corporate equivalent of a velvet rope? With Ron Burkle and Ukapa at the helm, the company is entering a new Chapter 1 that will be defined by a singular focus, making the business financially sustainable. The era of growth at all costs is likely over. Instead, we can expect a period of consolidation optimization and a renewed emphasis on the core product. The primary goal will be to prove that Soho House can be not just a cool place to hang out, but a genuinely profitable enterprise. One possible path forward is a less is more approach. The company might slow down its aggressive global expansion and instead focus on enhancing the profitability of its existing locations. This could involve renovating older properties, refining the food and beverage offerings to improve margins, and finding new revenue streams within the existing clubs. It's a high-stakes bet on the idea that by removing itself from the public eye, Soho House can finally become the business it always promised to be: exclusive and desirable, and most importantly, profitable. The whole creative world will be watching to see if they can pull it off.